Most people who invest in the stock market lose money. Let that land for a second. Not because the market is rigged, not because they weren't smart enough, but because they broke the same 5 rules, rules that every successful investor quietly lives by. And here's what's wild. The S&P 500 has returned an average of 11.8% per year since 1957. That's almost free money sitting on the table. Yet somewhere between opening a brokerage account and actually building wealth, the average person managed to lose their own money in a market that goes up the majority of the time. So today, we're going to fix that. 5 rules. Real numbers, no fluff. But I'll warn you, rule number 1 is going to feel completely backwards at first.
Here's the thing about the stock market that nobody explains properly in school. Everyone talks about when to buy. Buy low, sell high. Get in before the crash, get out before the dip. Sounds smart. Doesn't work. There was actually a study on this. 2 hypothetical investors. Both put $10,000 into the S&P 500 every year for 20 years. Investor 1, perfectly lucky. They bought on the lowest day of the market every single year. Investor 2, complete opposite. They somehow bought on the highest day every year for 2 straight decades. You'd expect a massive difference, right? Here's what actually happened. The perfect timer ended up with an average annual return of 12.25%. The worst-timed investor, 10.54%. After 20 years of always buying at the worst possible moment, their $200,000 in contributions still grew to $626,978. Let that sink in. The difference between perfect timing and terrible timing is roughly 1.7% per year. But the difference between staying in the market and sitting on the sidelines, that's everything. Over the last 82 years through 2024, 100% of 10-year periods in the S&P 500 have been positive. 100%, 0 exceptions. So stop trying to predict the top or the bottom. Your job isn't to time the market. Your job is to stay in it. Time is the weapon. Use it. But staying in the market only works if you don't blow yourself up first, and that's where most people go wrong. That's rule number 2.
Picture this. It's April 2025. You wake up, check your phone, and the S&P 500 just dropped nearly 20% in a matter of weeks. That actually happened right after tariff announcements rattled the market. Your portfolio is bleeding. Your gut is screaming, sell everything, get out now. And here's where 90% of people make their career-defining mistake. They listen to their gut. The investors who panicked and sold in April 2025, they locked in their losses. The ones who held on, they watched the S&P 500 still finish 2025 up 16%. 16% after a near 20% crash mid-year. This is the cruel irony of investing. The market is designed to feel terrifying right before it rewards you. Here's a stat that should reframe how you see downturns. According to JP Morgan, the average bull market delivers a cumulative return of plus 221%. The average bear market loss, minus 39%. If you miss the bull markets by hiding during the bears, you've already lost the whole game. Emotion is the enemy. Build a plan and then commit to it like it was written in stone before the crash happened. Because the investors who got rich weren't smarter than everyone else. They were just calmer. Which brings us to rule number 3. And this one's where most beginners skip straight to the exciting part and regret it. Everyone knows don't put all your eggs in one basket, and everyone ignores it. Look at 2024. The stock market had an incredible year. The S&P 500 was up 23%, but that wasn't evenly distributed. The gains were almost entirely concentrated in 7 tech stocks: NVIDIA, Apple, Microsoft, Meta, Amazon, Alphabet, Tesla, the so-called Magnificent Seven. They accounted for more than half of total S&P 500 gains. If your entire portfolio was riding those 7 names into 2025, the next year humbled you fast. Because in 2025, tech was no longer the top sector. International markets started outperforming the U.S. Value and growth stocks returned almost identical amounts. The year's single best performing asset class? Gold. Nobody saw that coming. That's exactly the point. Diversification isn't about being boring. It's about making sure that when you're inevitably wrong about something, and you will be, you don't blow up your whole portfolio over it. Spread across sectors, mix in international exposure, consider asset classes beyond stocks. The investors who survive long enough to get rich are the ones who can afford to be wrong about individual bets. Now, diversification protects you from catastrophic loss, but rule number 4 is what actually makes you wealthy.
This is the one rule that separates people who end up with $200,000 from people who end up with $2 million, even if they started with the same amount. Compounding is stupidly simple. Your returns earn returns. The longer you wait, the faster it accelerates. But here's the part people get wrong. They treat it like a background process they'll set and forget later. They delay. They wait until they have more money. They wait until the market calms down. And that delay is devastatingly expensive. Consider this. If you invest $1,000 a month starting at age 25 at an average return of 10%, the S&P 500's historical average is around 10 to 11.8% depending on the time period, you'd have roughly $6.3 million by 65. Start at 35 instead, you'd have about $2.3 million. Same contribution, same return. A decade's delay cost you $4 million. The market hit 39 all-time highs in 2025 alone, and data shows that if you invested the day after an all-time high, your average 3-year return was 46%, actually higher than the average 40% return in any 3-year period. Stop waiting for the perfect moment. The perfect moment was yesterday. The second best time is right now. But compounding only works if you don't sabotage it by breaking rule number 5, and this last one is the one nobody wants to hear.
Here's a quiet killer that almost nobody talks about when they start investing: fees. A 1% annual fee sounds like nothing. It's $1 on every 100. No big deal, right? Run the numbers over 30 years. On a $100,000 portfolio growing at 10% annually, a 1% fee doesn't cost you $30,000. It costs you over $170,000 because you're not just losing the fee, you're losing all the compounding that fee would have done for you. This is why index funds changed everything. The S&P 500 has returned an average of 11.8% since 1957. Most actively managed funds, the ones charging you 1%, 1.5%, 2% in fees, don't even beat that number. According to research, over 80% of active fund managers underperform the index over a 15-year period. You're paying more for a result that's statistically worse. The formula isn't complicated. Low-cost index funds, long time horizon, consistent contributions. Don't panic. Don't overtrade. Don't let fees silently drain your future. The boring path is the winning path, and the numbers back that up every single time.
Let's recap the 5 rules fast. 1. Time in the market beats timing the market, always. 2. Emotion is your biggest enemy. Build a plan and protect it from your own panic. 3. Diversify. Be wrong about individual bets without blowing up your whole portfolio. 4. Start compounding now, because every year you delay costs you exponentially more than you think. 5. Keep your fees low. They're silently stealing your future. The stock market is one of the few places on earth where patience is a genuine superpower. It's gone up 100% of the time over any 20-year period since records began. There were no negative 20-year stretches. The worst 20-year return? Still 6% per year. The best? 18%. You don't need to be a genius. You don't need insider information. You just need to follow 5 rules that most people know but never actually follow. Now you do. Use them. If this helped you, drop a comment. Tell me which rule hit hardest for you. And if you want the next video on exactly how to build a low-cost index fund portfolio from scratch, it's already up.